thank you all for being here. I'm just thinking it's probably the toughest gig at the conference to follow Saylor right after his keynote, which is, you'll notice I go first on the earnings calls now just to avoid that risk. But I think we've got a great panel for you guys to kick off the remainder of the schedule. And we're going to focus today's topic on expanding a little bit more about digital credit, the innovations that are happening, sort of what we're seeing in terms of market dynamics, how we think about risk, how we think about the next stage of digital credit in the future. So I'm very glad to have our guests with us here today. We heard a little bit, obviously, we've been on the journey of the evolution of the Bitcoin Treasury company. I think we also are, well informed now on the evolution of digital credit. I think it would be great. We talked a lot about what Strategy is doing. I think this is a great opportunity to see what others in the ecosystem are doing. So maybe to kick it off, maybe I'll start with Matt. It'd be great to hear from you how you think about digital credit, how you are thinking about that for Strive and some of the innovations you're thinking through.
Yeah, so when we saw Strategy launch digital credit last year, it fixed a missing link in my mind that the convertible notes did not satisfy, which is, as an investor, I love the convertible notes. So Strive is an asset management shop. We have a fixed income ETF. We own the convertible notes and the fixed income ETF. I think they're awesome investments. But as an issuer, it was pairing what I think is a extremely long duration asset and a great asset in Bitcoin with a long duration liability. And you want the longest duration liability so that way you really can zoom out and think in 5, 10, 15-year increments, which is what a corporation should do. That's when you think about fiduciary duty, there's always been a lot of criticism about companies thinking quarter to quarter or month to month and not thinking about the long term. And digital credit solved that to me. And it allowed you to think about amplified Bitcoin from a properly hedged liability. And so that was it on the company side. And on the buyer side, it also fixes that problem because now you can look at the company's balance sheet and also zoom out that you're underwriting their ability to meet those interest obligations. And you could underwrite it not from the perspective of a company with unknown future cash flows, but as a balance sheet company. And I think these are the most mispriced assets out there. I mean, I view Strategy as literally AAA grade credit. I think Strive is investment grade credit. But you can still have a win-win because of the earnings potential of Bitcoin into the future.
Great. So maybe moving on to Dylan, Metaplanet has had a tremendous amount of success raising capital in the Japanese market, developing that true narrative of, the Bitcoin Treasury company globally. How are you thinking about digital credit? We talked a little bit today about the evolution that a corporation can go through. Be great to hear your thoughts on what Metaplanet's thinking.
Yeah, of course. Well, excited to be here with some pioneers in the space. I think we should appreciate how nerdy everyone is in this room talking about preferred equity and capital structures. So very niche conversation, but very exciting conversation. I think on Metaplanet in May of 2024, when we pivoted in April, in May, we published a white paper on kind of how we think about Bitcoin, our thesis, what our company is trying to do. And in that paper, we said we want to be perpetually long Bitcoin and perpetually short fiat currency. I think we said it a bit more, buttoned up than that. But that was before preferred equity and digital credit actually was released and discovered by the Strategy team. And we didn't know at the time, what the evolution of that would look like. We were thinking, similar to the convertible bonds or, the traditional liabilities on the capital structure. And so fast forward, Strategy IPOs 5 preferreds. It's very clear that this is the ultimate capital structure for a Bitcoin Treasury company with a long time horizon. And so we have authorized 2 classes of prefs. The senior one being a variable rate preferred, we're calling Mars, and Metaplanet adjustable rate security, and we've as well as a convertible preferred stock, we're calling Mercury, which Metaplanet convertible for return and yield. We've done a pre-IPO of that, so 150 million notional at a 4.9% face value, 5.4% effective. And our intention is to IPO 2 of those this year. Japan is Japan, so sometimes things take a little bit. But we're laser focused on that capital structure. The kind of the dual pronged approach of common equity and preferred equity gets a lot of tools in the arsenal, as you guys have shown. So we're really excited. We're laser focused on it, and it's been a fun time educating the investors and educating the Japanese market on this new innovative strategy.
Yeah, I having been in the TradFi space historically, I know markets globally can be different dynamically, and I know the Japanese market is one where it takes a little bit of time to penetrate, but once you get that foothold, it's very durable, right? And so it sounds like you're going through some of those iterations to find out what investors want, what type of demand is out there, and it may take a little longer in the Japanese market, but I think when you guys put that out there, it'll really take off. So speaking sort of in the context of investors and sort of what market dynamics are out there. Maybe I'll shift over to Ben as the CIO of Strive. How do you think about investor demand of these digital credit products? We talked a little bit today about retail, institutional, corporate. I'd love to get your thoughts on how all of those constituents should be thinking about digital credit as an investment opportunity.
Yeah, what's been really fascinating when we were going through the process of launching Sato was how wide the investor net actually was. When you're launching one of these, you never know exactly where the demand is going to come from when you're launching novel products, right? Bringing digital credit to the market is bringing yourself out of the analog credit market we've got today and bringing them something new, something more liquid, something with better yield profiles than they're used to. But that speaks to a wider range of investors. We saw a lot of institutional demand in it. We were well oversubscribed on both the IPO as well as the follow-on, but we also saw a tremendous retail demand on it, far bigger than we even thought we were going to see. And I think the reason you're seeing that is that these types of credit products, when you're pairing it on top of something that we believe to have a long-term CAGR of around 30, when you can strip off a really attractive portion of that yield and provide that cash flow and that income to these investors, it fits into a wide variety of portfolios. It's not only good for, these hedge funds or these portfolio managers that have a benchmark rate that they have to provide alpha on top of. It's also good for the community that's coming into retirement. We have a huge cohort of the nation that's about to enter retirement where you start to shift the way that you deploy your assets. You're moving into that traditional 60-40 split of the portfolio that you commonly hear about, and any opportunity to average up the fixed income portion of that is something that's really meaningful to that individual's life, right? It's another trip to Disney with the grandkids or being able to travel to visit family. It makes a material difference. And I think that bringing these products into the market, it's actually been really surprising to me, the amount of enthusiasm I've seen there. When it comes to a lot of the institutional investors, I think a lot of that demand is going to scale up over time. You're looking for things like track records out of these new products getting launched, and a lot of these institutional investors are going to want to see something like 3 years of those dividends getting paid so that they can feel secure with these products and go back and back test them against different market conditions. And I think as soon as we start to hit those marks, you're going to start seeing the inflows really ramp up into these credit products.
Yep. I think about the word evolution, right? Because we are defining something new. We're innovating around something that's never existed. We're changing people's minds to really understand. I know everyone has memorized the math equations that Michael just went through. We'll probably be studying them tonight. But, one of the things I realize is there is a growth in understanding, right? I think about how Strategy was raising capital first primarily through institutions. We knew that was a little bit of a education process as well as a closed infrastructure. We went to retail. Stretch was the largest pref that we had to a retail IPO offering. And now I think part of what we're going to talk about more through the next day and a half is how corporates are thinking about investing in digital capital, digital credit. And I think there'll be some pretty cool announcements too that we'll hear about. So I guess moving to off of like what digital credit is to like sort of the current market dynamics. Maybe I'll pass this one to Matt. We are in a unique place today, a little bit of a bear market. How do you think about volatility around Bitcoin? How does that impact digital credit? How do you think about structural protections around the instruments that Strive and Strategy are putting into the market? How should an investor think and feel okay about that today?
Yeah, so I think what Ben talked about on the track record building is so important. I mean, you have this room, as Dylan calls it, we're a bunch of nerds, right? Talking about preferred equity and going deep in all these math equations and dissecting everything and understand the opportunity here. But you look at a pension, like I worked at CalPERS for 16 years. They wouldn't look at a pref until you've likely made interest payments for 3 years. And that's not when they cut you a check for $1 billion. That's when they look at you, right? And so I look at this bear market as something. We always expect bear markets in Bitcoin. We never predict when they're going to happen, kind of perpetually underwrite a 30% CAGR or whatever your CAGR assumption is. But a bear market answers, I think, the biggest unknown question of digital credit, which is, will the issuer make the interest payments through a bear market? And I mean, I can't even tell you how many times I get the question of, is Strategy going to have to sell Bitcoin? Which we know is a laughable question. I mean, we're in the midst of a bear market and you're buying Bitcoin every single week. But then you take an issuer like Strive, which by design is more amplified than Strategy. And, that's another question that we have to answer, where this volatility is the gift that gives the return potential and also the opportunity for us as issuers to prove that these are investment grade credit opportunities, that when Strategy says we're going to defend 100, that you're defending 100. When we talk about, it introducing a cash reserve, the cash reserve is a new innovation on the prefs that weren't part of kind of version 1, but I think make a lot of sense to help handle these times of volatility. And as these things happen, the cost of capital, I think over time will come down. And, it's funny, yesterday I had a conversation with Fong. We had one point of disagreement. We actually both agreed that there's going to be 30 billion plus of prefs on Strategy in the near future. And I called that linear growth and he called that exponential growth, but we both agreed it's going to 300 billion in the near future. That's exponential growth, but that's because of what track record building does. And so I think this time is actually a good thing and healthy for this ecosystem.
I agree. I think, I often tell the story that I joined Strategy in the summer of 22, right? And going through those types of iterations helps you understand, one, sort of the volatility of Bitcoin, but it also helps you understand how you get out of that and what happens once you get past, a so-called crypto winter. One question I have, and you alluded to it, there's cost of capital, there's market dynamics, there's things like, credit ratings, there's education on Bitcoin, institutional adoption progression. Maybe this one for Ben, what's the biggest opportunity for investors? Is there an arbitrage right now? Are we, what are we missing? Why should people do this now and not wait 3 years?
So our chief risk officer has a saying that he says a lot, which is risk is mispriced everywhere. And whenever you have a mispricing in the market, that's where the opportunities come out. Once people really digest what the risk is or how low the risk is relative to these instruments, those spreads are going to compress in a big way from where they are right now. Right now we're quite wide from the risk-free rate that's out there. But over time, as these gain adoption and as these build their track records and investors realize that these are more secure products, for the unique reason that we already have the assets. I think that's something a lot of people miss with credit products, but it's getting highlighted currently with all the innovation and the disruption that's happening. It seems every day there's a new AI tool getting launched into the market that wipes out, the market caps of all these other companies, which starts to mean that those future cash flows from those businesses are far less certain than they used to think that they were. And a lot of these would be able to issue investment grade credit products. But you're starting to see that in a world of disruption, that is far from a certainty anymore, right? The world is changing around us and we can't see around the corner to see what's happening. What we're doing, though, is we're building these products on the top of capital. We have the capital. That's the core foundation of all of this. And I think that's missed in the market, how strong that is. If the cash flows go away from all these other businesses, but you're left with no strength left on the balance sheet, those investment grade products, are more junk products at that point. And so there's definitely a misunderstanding of risk out there. And I think that comes with any new product you're going to launch into a traditional market. The same way that people were resistant to music going digital and videos going digital and everything moving into the digital age, credit moving digital as well is going to take a learning curve, and it's a different model and it's a different type of capital that we think is the best form of capital in the modern world. But it's up to us, the onus is on us to help with that education effort to make sure that the rest of the people start to understand what a true risk profile looks like when you're building it on sound digital capital.
So should people buy now?
The best time to buy was yesterday. The second best time is today, right? That's the saying.
Dylan, I guess, pivoting to you, I think one of the valuable perspectives you bring is just, obviously strategy and driver issuing in the U.S. markets. How do you think investors in Japan or, anywhere else globally think about some of these embedded risks and some of the progress that needs to be made for further adoption?
Well, I'm going to answer your question in a way maybe that it wasn't asked, but I think the most interesting thing I find about Stretch, SATA, digital credit, these variable rate instruments that have a stable like price, for those that were in the Bitcoin space in 2020, 2021, 2022, or crypto more broadly, there was a few narratives and a few things that people were really, really focused on. One of them in 2021 was there was this explosion of kind of open interest in the futures market, and there was this thing called Contango. And the Contango was basically, people were really excited about Bitcoin. They wanted to get leverage long Bitcoin. There wasn't really many avenues to do it. And places like Deribit and Binance and, all of the crypto derivatives exchanges, there was basically a 40% annualized, interest rate for, the Bitcoin native cost of capital. And a lot of the Bitcoiners, the Preston Pishes of the world, myself, we're saying, Bitcoin's going to eat the bond market. It's really obvious. You buy Bitcoin, you short Bitcoin futures, you capture a 40% spread in, basically a risk-free delta neutral way. It's going to eat the bond market. And, for many reasons, one being the plumbing wasn't there, that didn't occur. But, the more interesting thing, I think, is that in the crypto world, there was a lot of these, DeFi tinkerers and engineers and financial engineers that for the longest time we're trying to create a dollar or basically a synthetic dollar without counterparty, without kind of a centralized custodian like a traditional stable coin. And what most of them came up with, none of the implementations were perfect, was, well, if you have Bitcoin or Ethereum or one of the crypto assets and you short the futures contract, you can create a synthetic dollar with a variable funding rate. And no one really found a big TAM for that. There wasn't anything that really caught fire. There was a few implementations, but the most beautiful thing about this was that the crypto people spent so much time trying to figure this out, and then Strategy came and launched it on the Nasdaq. This is a floating rate instrument that's not a stable coin, but it's a very, very stable like price. And so with this, two of those kind of theses or questions were answered at once. One, how is the Bitcoin native cost of capital going to pull in fixed income from the bond market? And then two, this kind of age-old question in crypto of, how do we kind of create this stable-like instrument backed by Bitcoin collateral? And so, these instruments, digital credit, did both of those things at once. This is going to be a big, big magnet for bond market capital. And two, all of the crypto people that spent so much time thinking about it are sort of they haven't really realized that, we're doing this in the big leagues, in TradFi. So I didn't really answer your question at all, but I wanted to kind of get that across because I find it so exciting. Because this was a question a lot of people spent a lot of time talking and thinking about, and now we're doing it in big size and on the Nasdaq on publicly traded stock exchange.
Yeah, no, I appreciate the foundational concept of how this is working, but I'll go back to my question. Just what are the dynamics that you're seeing in a global market like Japan around some of these concepts? Are there any hurdles? Just any sort of context there, because I think from our standpoint, we're obviously issuing preferreds in the U.S. We've issued a preferred in Europe. We think in other regions and geographies. I think it'd be great to just hear sort of what you think about the Japanese market overall in these types of concepts.
The Japanese market is a huge fixed income market. The preferred market's very, very nascent. There's 4 listed preferreds. So there's private markets, but there's actually more perpetual bonds in Japan than there are perpetual preferreds. And so this is a market that's very, very sleepy, as Simon likes to call it. And we plan to be innovators here. similar to Strategy's experience or Sailor, the story he likes to tell about kind of grinding away with ChatGPT to figure out these instruments. No one had ever done all of the things like when we authorized the variable rate instrument. The lawyers and the regulators had never seen anything like this. So it took a lot of time to kind of explain it, say, these are the mechanics, it can be done. The issuance is the next step, but the first critical step, getting it authorized, getting it approved by shareholders, that happened at December of last year.
I think if you took the narrative of you can't do this because fill in the blank, I think we probably fall short of all of the things that the Bitcoin Treasury community has done over the past couple of years. And we've certainly evidenced that. Michael alluded to it. We went through 10 iterations before we got to the 11th. I was talking earlier today in our focus group. I was thinking about that first preferred we did. There was a lot of R&D. There was a lot of you can't do this. There was a lot of breaking the glass ceiling, so to speak, around some of our counterparts. But it's that focus and intention to just keep pushing. And I think if there's any example of the U.S. market, it'll eventually come to life. I guess last question on market dynamics, and I'll just throw this up for anyone. Jump ball here. 2025 was really the year of the pref, right? And I think we saw today, in particular, stretches, trading at 10x multiples of the other pref in the liquidity of prefs in the market. How do you think about just secondary market liquidity? How do you think about how does that improve over time? What catalysts are there to keep that running, and how do we grow this to a larger depth?
So my view is this is actually going to be very similar to growing an asset management ETF business. And there's kind of a tried and true playbook of what success looks like there. And it's that the first 3 years is basically hand-to-hand combat. What I mean by that is you're going out there and you're earning every new investor in the space. You have no track record. You have a great idea, a differentiated product, and you're going out there and, tomorrow Ben and I go to a different conference that is high net worth cash flow investors in Vegas that have probably never invested in Bitcoin. What's the concept? Digital credit, right? And that kind of scales linearly, which is, $30 billion is my prediction for you guys. And then once you've earned the track record, then that linear, but quick growth quickly becomes a hockey stick of exponential growth because you've earned and built that liquidity profile over time as an issuer, doing what you're saying, expanding the marketplace, going out there and telling the story. I think that's exactly how this story is going to play out. And I think it is a iPhone moment, but it's also the credit spreads say that it's early, and that's the opportunity of, why you should buy it today.
Yep.
I think it's all, one of the things to note is that we really haven't seen a Bitcoin bull market in the era of preferreds, right? So, Bitcoin's kind of dropped sideways, and then, the last few months have been down. So, I don't think people are really understand what happens when, Bitcoin re-rates a lot higher, and then all of a sudden, the balance sheet of all these companies becomes, that much stronger, and it's going to be extremely reflexive. And so, I think, the performance over the last 3 months, continuing Strategy buying Bitcoin every single week, issuing Stretch, issuing MSTR common stock. I mean, this is when Bitcoin returns as it always does, and we're seeing the obituaries today. So we know how this plays out for anybody that's spent some time in this space. I'm really excited just to when these conditions flip, and when that happens, the narrative and everything else will flip with it.
Yeah, I would say one of the most underappreciated characteristics of all these products is that liquidity profile. I don't think that's very well understood. With traditional equities, if you go talk to anybody out on the street who just has a general understanding of a stock, they would tell you that demand is shown in the price. And I would say that demand is shown in the liquidity, right? It's showing that there's activity, it's showing that there's interest. And when you look at these preferred products and how they're trading in the market, or if you even look at the common equities, Strategy is one of the most liquid stocks out there. That liquidity is growing all the time. And I think that's a signal of the demand starting to flow into these. And as you start to see weaknesses in other part of the market, right now what's being highlighted is the private credit market. And people are figuring out that there is risk there and there's a lot of liquidity risk that's there. So when you get these preferred instruments that are trading out on exchanges and there's liquid and there's a lot of demand for them because they have these great characteristics we talked about earlier, I think that is going to start to attract eyes to these, where people are going to have to start looking, because when you see that demand profile growing through the liquidity, it starts to make you wonder, what is it I'm missing that everybody else is seeing? And I was talking to an institutional allocator here yesterday, and he goes, the problem for the prefs is likely the marketing. You've got to get out and talk to more people, because if 1% of people have found these and they learn what these are and they really evaluate what the risk, 90% of them probably already own it. It's the other 99% that still have a learning curve here that need to gain an awareness of these products. And so when you think about things like traditional screeners around these products and what draws the eyeballs of these allocators, it's going to start popping onto more and more radars. And I think that as long as we do our job on the marketing front and the education front, the capital flows are going to come in, and probably quicker than we think.
Yeah, I reflect on the comments around marketing and education. You guys mentioned that you're going to be at another conference. I think we've activated Michael and Fong to the most that they've ever been on the road in the past couple of quarters. I think what we've realized is there's a tremendous amount of just people not knowing, and you have that initial conversation of, here's the product, here's digital credit, here's what it pays you, here's how it's price protected, here's how it's perpetual, and it's almost like you see a light bulb go off, and they're like, oh wait, like, are you serious? Like, yeah, please sign me up for that. And I think we're seeing that with institutional investors. We're certainly seeing that with retail investors. I think we're seeing it more and more with corporate balance sheets. I think that ecosystem will continue to grow as you guys and Strategy and Metaplanet and others like us get out there and really tell the story. In the last few minutes, I guess I'll flip to, we've defined what digital credit is. We've defined how investors think about it, what the market dynamics are. What do you guys think is next? I think of Bitcoin as the layer one, and Michael talked about this. Stretch for us is the layer two. I think there's going to be products that are going to be built on top of Stretch, just given the intrinsic capabilities and the nature of the yield generation. Maybe we'll just go down the line and get everyone's thoughts on what's the future going forward.
Yeah, the ability to innovate on digital credit is near endless. And so you've heard Michael talk about digital money, stripping down the vol, zero volatility. I'll give you an example in ETF space. Is one of the most successful new ETF categories is what's called a buffer ETF, which is taking like an S&P 500 and protecting it 10, 15% to the downside. Something like that on digital credit makes all the sense in the world. And then the flip side of that is levered digital credit. And that, I think, makes an extremely compelling case against private credit. So private credit might have like a 13, 15% yield for some of what financial advisors are buying. And it's so easy to highlight the risks of digital credit and the exit liquidity that the digital credit issuers are pushing out into the market, putting things on chain. Like I will spare my bearish case for private credit, but if I can offer the same thing, but with digital credit, with a balance sheet company that doesn't have AI risk, but actually has something that's scarce in the world of abundance, I think that the demand for that is endless, but it requires innovation on top of that layer two.
Yeah, I mean, I'm really excited about the second and kind of third order applications and I guess wrappers, if you will, that are being built on this asset class. We had a dinner last night and spent probably 90 minutes with the table just talking about various opportunities here, whether it's domestic on a through an ETF, or whether it's on chain kind of crypto native, or whether it's foreign in a foreign currency with a currency swap. I think there's really endless opportunity here, and having kind of seen the crypto playbook, if you will, with lending protocols and collateralization and stable coins, it's very clear there's going to be a couple category winners in a big way. And I wouldn't be surprised if next year at this conference there's 3 or 4 different companies or quasi protocols, if you will, that have over $1 billion of Stretch, SATA, and other digital credit exposure.
I think for entrepreneurs, you just need to give them the tools to build with. And so I think the work that's happening right now for us, kind of building that first layer of digital credit is going to really open up the creativity channels. The world's getting really small, particularly when you start to think about the ability for some of these entrepreneurs to take these securities and then put tokens that they can distribute globally around them and bring some of the characteristics. But I think what was really important was to get multiple issuers into the market first, so that now you had more legitimacy around these products. You've got more people out there that are telling you about them. You've got more characteristics around the different yield profiles and whether they're convertible. And people can now structure products around that. You're giving other people an opportunity to go build something and make money for themselves. And, in this world where everything's moving really fast, everyone's, enabled by their silicon to come up with all the creative ways to get things done. I think that as soon as you release those tools, you prove them out, you prove that you're a good steward of maintaining your balance sheet and building a company that can endure through the bear markets, right? You're building for resiliency. I think that the winds get behind you and you're going to start to see a lot of really creative things happen over the next 12 months.
Great. Well, I thank you, gentlemen, for helping us kick off the remainder of our agenda. I think we've got a great schedule. I think we'll hear more about some of these concepts and maybe even, definitely some specific applications to some of the ideas we've talked about. So I want to thank you all and appreciate your time.